Hi, class. Welcome back to our next topic. We're going to be talking about volatility smiles in this lecture, and it comes, right on the heels of talking about the Greeks. So, in terms of our plan of attack, here's our agenda for the class for this, lecture. So, we're going to start with a basic definition of, the put-call parity argument that ties calls and puts together, right? And then we're going to look at a couple different examples of, you know, foreign currencies and then in equities, how volatility is different, or I should say, implied volatility is different for these types of options. And then we'll move into talking about how practitioners sort of actually describe volatility smiles. And then last but not least, we'll cover a case when the smile inverts. So as we get started here, um, in this section, we're going to define what the volatility smile is. And then we're going to prove using put call parity that there's really only one smile. And because calls and puts at the same strike price must have the same implied volatility, which is maybe a surprising but useful result. Now, just as a reminder, I might have glossed over this in the last lecture that the volatility parameter, sigma, in the Black-Scholes-Merton model is set equal to the implied volatility when we're calculating those Greek letters. So what is implied volatility? Just, generally speaking. Well, remember that a call or a put's price, and I'm going to do a little drawing here, let's say a call's price is going to be some function of all the input parameters that we've already talked about when we talked about the Greeks, right? We talked about, obviously, sigma is one of them, right? We talked about the share price, the strike price, time to maturity. If there's any dividend yield, we can incorporate that as well. And of course, interest rates, that should be an R. So these are our main sort of inputs with, we can kind of ignore the yield for now, but these are the main impacts, or I should say input parameters that affect the value of a call or a put option, right? Now, what's interesting is that volatility is based on historic return data, or more specifically, historic prices of the underlying asset. Um, and it turns out that you cannot actually see instantaneous volatility because you need a history of prices in order to calculate the deviation from the mean, which is, volatility or one measure of it. But what we can observe in the market is as follows, right? We can observe what the current share price is. We can observe what the strike price is on the option contract, the time to maturity, the risk-free rate. We can observe all these things. And importantly, we can also observe the actual call price in the market, or put price for that matter. What we cannot observe instantaneously is the volatility measure. So, implied volatility is actually the volatility number that makes the Black-Scholes-Merton model equation equal to the observed price in the market. So basically, it's backed out of all this other underlying data. And again, we can see the call price in the market, and we'll use that along with these other parameters to infer what the value of the volatility is. We call this the practitioner's Black-Scholes model, as you were. Okay, so what is a volatility smile? So, the Black-Scholes model assumes that the underlying follows, right, a random pattern. That is, the underlying stock moves according to something called geometric Brownian motion, right? The log normal randomness of the price. And it assumes that it is a single constant volatility, as I mentioned. So under this assumption, every option on the same underlying asset with the same maturity should give a price that is consistent with having the same volatility. So again, if we invert the observed market prices back into volatility, we would get a flat line, specifically saying if we did something like this, right? If we said for every strike price on this call option, and we had implied volatility here, on the other axis, well, according to the Black-Scholes-Merton model, there should be no difference in volatility. That is, for any given strike price, right, you should have the same volatility, and I'm going to call this volatility for the BSM, right? The same constant volatility because, right, it's referencing the same asset. That's sort of the intuitive implications of the Black-Scholes model. However, in practice, the implied volatility does vary systematically with the strike price. And we call that curve the smile. And that's what we see down here at the bottom. And the smile is, telling the market uh, that the Black-Scholes-Merton model is wrong, right? Or maybe more precisely, that the true risk neutral distribution is maybe not so log normal. And so the shape of this smile tells us how different from log normal. So today is this is what we'll focus on and learn how to read what the shape is telling us. All right, so backing up a little bit here, calls and puts will have the same volatility smile. And the argument follows these 2 points. And this is probably the more important point of the whole lecture, is that both implied calls and puts, and we always start from the European style call and put options. If they have the same strike and the same maturity, their implied volatilities are going to be identical. Exactly identical. And an argument comes from the put call parity, but applied twice. And it's, based on this no arbitrage condition. It has nothing to do with which model is right per se, and therefore it holds for both observed prices and implied market-based, I should say, theoretical prices as put forth by the Black-Scholes model. So, for example, if you look at the market equation here, right, if we have the price of the put option according to market prices and the sort of present value, discounted present value of the share price based on the yield, right? This is for a typical index, if you will. And we set it equal to the call price observed in the market plus the present value of the risk-free rate of the strike price. It should look very similar to the Black-Scholes model. And you'll notice here the only difference is the subscript. So when we sort of take these two at face value and simplify, it must be the case that the difference between these, subtracting these two parity equations, it cancels out the spot price and the strike price rates. So it must be the case that any differences between the put price observed in the market relative to the model must equal the difference between the call price observed in the market relative to the model. So it's identical, meaning the differences between these are identical. And so one implied volatility measure will fit both call or put, right? It's that precise. So just one single implied volatility that will reproduce both prices. So we only have to worry about one smile, thankfully, not a call or a put smile. There's only one to worry about, right? So the takeaway on that prior slide was at a given strike and maturity, the implied volatility of the call must equal the implied volatility of the put. Now, for European options, this is going to be exact, okay? For American options, it's approximately true because we have that early exercise premium that can create some small differences, but in practice, they're relatively negligible for index options and for most individual equity options. The practical convention that this therefore enables is that traders typically quote out of the money options on both sides, right? So out of the money puts for low strikes or out of the money calls for high strike prices because the out of the money options tend to be a bit more liquid. And of course, since calls and puts share a smile, then mixing them on the same plot is totally fine. All right, so let's talk about the volatility smile for foreign exchange options. It's the sort of cleanest place to introduce this because it gives us a symmetric outcome. So it's a nice clean visual for implied volatility versus a log normal comparison. And then we'll take it to the empirical data to see if it's true. Okay. So you'll see here for foreign exchange options, the shape of this is a roughly symmetric U-shaped curve. So what we're doing here, just to define things here, we have implied volatility on the y-axis, and we have the ratio of the strike price to share price on the x-axis. So essentially, it's sort of in the, here in the middle of the x-axis, this is basically where the share price and the strike price are equal to each other. So the option is at the money. Um, now, these deep out of the money put options, so if we're looking over here, or deep out of the money call options, suggest that, large currency moves in either directions will trade at higher implied volatilities than at the money options. Right? That's what it's telling you. Higher implied volatility on the left side, higher implied volatility on the right side, and lower in the middle. And this symmetry makes some sense intuitively, right? There's no obvious reason, for example, that a sharp dollar yen move should be more likely up or down because, currency pairs are relative prices, and a big move down for one side of the pair is a big move up for the other side. So, we'll see in a moment that this symmetry breaks down a little bit in practice. There's always almost some asymmetry driven by carry trade flows or central bank intervention. But as a first approximation, this smile looks like a U shape here. And so what does the smile tell us about the distribution of, in this case, spot prices in the market? Well, the mechanical link here between the smile shape and the implied distribution is that an out-of-the-money option only pays off if the underlying spot price moves a lot, right? So if the market is pricing the out-of-the-money option at a higher volatility than the Black-Scholes-Merton model would, then the market's effectively saying a big move is more likely than whatever the log normal predicts, right? So we end up with fat tails on both sides, and you can see that here. Here's our implied line here in the solid graph here. So there's fatter tails here, meaning it's the implied distribution is above the log normal distribution at the tails, right? And then that's true on both sides. Now, the other side of that probability mass has to come from somewhere, and it comes from the middle, right? So the implied distribution has a taller and narrower peak than the log normal distribution. So the net difference here gives us this intuition that the log normal underestimates both small moves, that is, staying near the peak, and large moves, and overestimates the moderate moves in and around the current at the money value. Okay. So how do we, empirically, how does this hold up? Well, here's the empirical evidence that the market is sort of responding to. Each row here is going to count the fraction of daily exchange rate changes that exceed the strike price, that exceed the 1, 2, 3, 4, K standard deviations. Obviously, this is where we're estimating volatility from the sample using the practitioner approach. So under the log normal model, and that's what you hear have here in this third column, for example, you'll notice here, let's say, 4 standard deviations out. This should only occur, 0.01% of the days, or basically never. Whereas in the real FX data, it happens 49 times more often, or 0.49% of the days that you have these 4 standard deviation moves in the spot price. You can even look further out on the tail, right? The 6 standard deviations, the log normal predicts it'll happen 0 times, whereas, of course, the real world frequency is 0.13% of the days in the data. So the market isn't necessarily being paranoid when it charges higher volatility for deep out of the money options. It's pricing the tails that actually exist, right? So one thing also to note here is that the one or two sigma moves here, these are all what you would expect more often to happen. These occur less often in reality than the log normal would predict, right? So the log normal would predict that a one standard deviation move would happen 31.73% of the days, whereas in practice, it's only about a quarter of those days where it stays within a one standard deviation move. So the evidence does seem to indicate that this does exhibit a more peaked distribution and obviously deviates, therefore, from the log normal distribution, giving us that U-shaped volatility smile curve. So why does this log normal model fail for foreign exchange? There's two features of the exchange rates that the Black-Scholes model does not capture. Now, the first is jumps. For example, like when the central bank intervenes, or there's surprise rate decisions from the Federal Reserve, or frankly, even when there's a currency peg break, like the Swiss franc did in 2015, commodity shocks, or even particularly commodity shocks for resource currencies, these are all going to produce a discontinuous price move that a Brownian motion, what we call a diffusion model, cannot generate. So a pure random path is continuous, right? There's no jumps. It just goes from one small increment up or down relative to the prior point. But foreign exchange data does have really visible cliffs that the model cannot replicate. Second here is that the is because volatility itself is stochastic, meaning volatility itself changes, often spiking in and around macro events. So when you fit a constant sigma model to the data, when the sigma is actually time varying, the unconditional distribution looks fat-tailed even if each day's conditional distribution is roughly normal. So basically, it's a volatility of volatility effect, and the BSM model can't account for that. Um, either of these problems alone would produce these fat tails we see, but we have both of them. So they explain most of what we see in the empirical data. And we have some evidence for this. So back in the 1980s, when Black-Scholes Merton model was the dominant pricing model, most market makers quoted off the single at the money sigma, right? Which meant that deep out of the money calls and puts were priced as if those tails barely existed, right? The log normal distribution. But in reality, FX options have fat tails. So a small set of traders ran a simple strategy, right? So you would buy deep out of the money options across any given currency pair. And most of these would expire worthless, which was fine because it didn't cost that much. But the ones that didn't paid off many, many multiples of the premium paid to buy those options. So it was often enough to deliver a positive expected return. So, by the late 80s, this was widely known, and market makers started fitting, smiles instead of single sigmas, right? Basically, through the 1980s, this arbitrage that was, a deviation from the model collapsed because many traders started taking advantage of it until the options started getting priced correctly. That is, the implied volatility smile started to arrive. So today we don't see, much opportunity for arbitrage, right? We see the residue of this adjustment, which is the volatility smile. So, the lesson in this case, of course, is that when the model doesn't match the data, those who are first to notice get paid, right? And once enough people notice, the market adapts and the gaps shrink. All right, moving on to our third section here, we're going to talk about equity options here. Now, here the smile is going to look different. It's going to be lopsided here, in fact, downward sloping, and we'll explain the shape. We'll work through the three economic stories for why it exists, and then take a look at some empirical evidence with a final look at some real data. So for equity options, the smile looks like, it's a skewed smile. Um, what do we uh, what we have here, it shows that the implied volatility is highest for the lowest strike prices. And this would be, of course, out of the money puts or in the money call options. And it drops monotonically as the strike price rises. So by the time you're at deep out of the money, call options here on the right-hand side, the implied volatility is well below the at the money value, which is somewhere in the middle here. So we call this a skew, or sometimes we call it a smirk, right? It looks like a emoji smirk face. It's the dominant pattern in single stock and equity index options since the 1987 crash. So before 87, the equity options actually had a smile that looked closer to the FX smile. It was more symmetric. But after Black Monday, the skew emerged and never went away. And we're going to see the three main reasons for this in a minute. But first, I want to show you what the distribution of underlying prices looks like here. The heavy, what does this heavy skew in the implied volatility smile say about the distribution? Well, it says it has a heavy left tail, right? So we have the implied market volatility, or I should say the implied prices here, tell us we have a lot more observations of lower price returns than a log normal distribution would say. It also tells us it's left skewed and truncates to well below what the log normal distribution would say about prices on the right tail. So what does this mean? Well, it means there's high volatility on the put side for the low strike prices because out of the money puts are going to be more expensive. It means the market is pricing a heavier left tail than long normal. And then on the right side, the call side for high strike prices means out of the money calls are cheaper. So it has this thinner right tail. So again, distribution is left skewed relative to log normal. It expects sharp downside moves, which are more, it's pricing in these as being more likely than the log normal would predict, and saying that big upside moves in the stock price are also less likely. And this this makes intuitive sense. Equity markets tend to crash, right? They don't like boom at the same rate of speed. So for example, the S&P 500 fell 20% in that single day in 1987, and it's never risen by 20% on a single day. So this implied distribution captures that asymmetry in price expected moves. Now, there's three reasons for this. All three share a sort of structural feature in that they predict a negative correlation between the level of the index and its volatility. So when the market falls, volatility rises. And when it rises, that is when the market rises, volatility tends to fall. And that's exactly what we observe empirically. And it's also exactly what generates this skew. So the first reason for this comes from leverage. So I've got to go back to your old corporate finance models here, right? So as the price of equity falls for a corporation, the firm's debt to equity ratio increases, right? Because the denominator, the equity, gets smaller. So it's mechanical. So the equity essentially becomes more levered, and as a result of that, equity volatility also increases. Second point here, there's this volatility feedback loop. So now that we have higher volatility, it's going to raise the required return to equity. Remember your CAPM model, right? So CAPM says if you have higher systematic risk or higher risk, you need to be compensated for it. So this is going to push down prices today because, right, that's your discount factor now. You just increase your CAPM beta, if you will, which increases your required return to equity. And then last but not least is crash phobia, right? Especially post 1987, investors now have a strong demand for out of the money puts as crash protection. So it mechanically bids up the put side volatility, right? Everyone, or implied volatility, because everyone's trying to buy protection puts, right? They're buying puts to account for potential crashes. So, I mean, all three are probably operating simultaneously, and researchers debate about the relative weights. But the point for us is that the skew is it's a robust feature, not necessarily an arbitrage opportunity, right? Because it deviates from the expected log normal model of the BSM. In fact, though, it reflects real economic forces. And so this is, basically a summary of what the prior 3 points predict, right? When the S&P falls, the skew will steepen. Uh, that is to say, the shape that we saw in the prior slide is not static. It can shift a little bit, essentially moves with the index level. So as the S&P fall, the skew itself will steepen. Um, and when it rises, the skew will flatten a bit. So, mechanically, a market decline, raises the perceived risk of a further decline. And so demand for out of the money put options spikes. So that left tail gets fatter, essentially. And so the put driven volatility or implied volatility, that is, put prices go up faster than the call side volatility prices, and the slope kind of gets steeper in that regard. And then the opposite's also true. So in a calm market, out of the money puts become cheap relative to history. So there's less sort of skew in that picture on the prior slide. So how do practitioners measure the skew of the equity option picture that we saw on the prior slide, or the smirk, if you will? They typically track this with a single summary number, and they call this the 25 delta risk reversal. And this is basically the implied volatility of a 25 delta put option minus the implied volatility of a 25 delta call option. And they use this as a sentiment gauge uh, when looking at the market. So let's ground this a little bit more in current market data. So when I put the slides together in May of 2026, the VIX was around 17, which is within its historically normal range of, call it, 12 to 20. So we would call that a moderate regime, if you will. Now, the number is the 30-day at the money implied volatility on S&P 500 index options, or specifically, it's the S&P 500 index SPX. So it's on the options for that particular ETF on an annualized basis. And so the VIX itself is a single at the money number, and it tells you really nothing about the shape of the distribution. So a typical 30-day a typical 30-day skew in a moderate regime, the 25 delta puts would trade at implied volatilities, 3 to 6 points above the at the money option, while the 25 delta calls would trade at 1 to 3 points below the at the money option. So that's, a 4 to 9 point spread between equidistant puts and calls. And so that's the structural skew. So I'm just going to redraw it here for our own edification. We have the ratio of strike price to the share price, and we have implied volatility over here. And so remember, it's sort of downward sloping like this, right? And so I was saying, if your at the money options are a 50 delta, point, right, 0.5 delta, that's your at the money option. And then you'd end up with, and what we're talking about here is the 25 delta put option right here. And then the other one would be the 25 delta call option, and that would be right here. They're equidistant from the at the money option, but there's a bit of steepness, right? So it says essentially that the put option is more expensive relative to the equidistant call option. Um, now, this is as of May. Now, if you contrast this with what happened in April of 2025, remember this was Liberation Day when the tariff shock hit. We saw the VIX spike to 52, right? So it went from call it 17 to 52, which was the highest end of day level of the VIX since middle of COVID, right? April of 2020. And so the put side volatility, implied volatility, exploded, meaning puts were expensive. The 25 delta skew ratio, right? The put implied volatility relative to call implied volatility, it hit 2.1, right? Which is pretty steep. It means that curve was even steeper than normal. Of course, the market's recovered and that spike kind of collapsed, and now we're back into this moderate regime. Um, so our sort of takeaway here is that the skew is structural. It never disappears, but its steepness will vary, dramatically with the different macro stresses that occur over time. Now let's pause here a second and think about, think about this. So the mental model here is that we have two sort of scenarios here. Um, um, and let me back up. I'll say, we have this mental model that talks about the higher density in a region of strikes, that is, higher out of the money option prices in a region lead to higher implied volatilities for those given level strike prices. A lower density, of course, would be the opposite. You'd have lower, um, and by density, I mean observations of the share price, right? Um, so if you have lower density, you have a lower implied volatility. So let's walk through these two different scenarios. Scenario A, we have a thin left tail and a heavier right tail. All right, so I'm going to draw a distribution here. Oops, let me try this. Sometimes this is helpful. So we have a thin left tail, so something like this, and a heavier right tail in terms of distribution of observed prices. Okay. Um, so we'd essentially see, oops, uh, yeah, this would be the distribution of prices here. Um, So in this scenario, we would basically have a reverse equity skew. Remember what we saw in with equities, our implied volatility um, picture would look something like this. Quite the opposite. Um, so what would be an example of this? It turns out that some some commodities, for example, commodity options show this when there's persistent fear of supply shocks that are driving prices up. So you see this in recent times, during the conflict in Iran, where we have this, supply constraint coming through, the global shipping channels there. Or it could be like soft commodities during a drought, so wheat, corn, things like that. In scenario B here, we have thin tails on both sides, but a heavier center. So from a distribution perspective, what does that look like? Right? So thin tails, heavy center. It's really tall. Whereas a log normal distribution, would look more like that. Once we take the expectation of it. So, what does this mean? Well, it means that we have a heavier middle, right? So our implied volatility would be, in terms of our smile or smirk here, there's our implied. Well, our implied volatility is in the middle because the observations are higher there. That means we have more observations of it happening. So we should expect options in this range to be higher and then lower on the wings, right? Basically, the reverse of a U shape. The market is basically saying this thing is going to land near the strike price with a pretty high probability and won't make a big move in either way. That'd be scenario B. And this is what you actually see ahead of binary events that, the market thinks are going to resolve gently, which actually helps us set up the next section, how we're going to characterize the smile. So, practitioners don't typically think of the smile as, the implied volatility relative to the strike. That's a bit more textbooky framing, which is helpful pedagogically to understand it. What they do use is something called moneyness, and they adjust it using forward contracts, actually. So they use delta as a substitute, if you will. They talk in deltas as opposed to strike prices. And then they extend the smile across different maturities onto a surface. So we're going to go three-dimensional here. So fasten your seatbelts there. So this will get us from the sort of textbook picture more towards the way an actual trade desk works here. So, as I mentioned, they characterize the smile by moneyness here. Now, first thing they do is that they define an at-the-money option using the forward price, actually, not the spot price, right? And the great benefit to this is that it incorporates any risk adjustments and dividend yields. Specifically, it's risk-neutral pricing. So it fits nicely with what we've already learned. And so the forward price is going to be the relevant anchor under our risk neutral measures here. So our expected price at maturity is actually F0, right? So an at the money option is when K is equal to F0, not the spot price, right? Now, secondly, when we change maturity here, our F0 is going to shift with the forward curve. So what's nice about that is mechanically the strike price whose moneyness is also equal to 1 will shift. So, when we're plotting moneyness instead of these raw strike prices, it'll make smiles at different maturities comparable to each other, right? Which is why we do that, right? It effectively puts them all on the same playing field from an evaluative perspective. We're basically accounting for time now by equating the strike price to the futures price. For short maturities, with zero dividends especially, the forward price is going to be equal to the spot price, so it doesn't really matter. For longer dated equity options or index options, or for high dividend paying stocks, underlying stocks, then using F0, this distinction matters. So we can't just substitute the spot price. It matters a lot, in fact. Okay, so let's characterize the smile by using delta. So we're going to be using delta to, basically talk about the volatility, if you will, or the price, if you will. This is the dominant convention, particularly in foreign exchange options and increasingly in common in equity options as well. So why are we using delta? Now, first reason we're using delta over using the strike price is that delta is bounded, right? 0 and 1 for calls, or -1 and 0 for puts. So the x-axis is fixed regardless of the level of the spot. So it's easy to compare across the underlying assets and across days. Second here, delta has a clean interpretation. A 25 delta call option is one that has about a 25% chance of finishing in the money, which is, still using the risk neutral measure, which is, pedagogically nice. Third here, hedging is done in delta space, right? We use delta neutral hedging. So a desk that thinks in delta doesn't have to constantly translate their exposures. They can speak the same language, essentially, when looking at different options. Now, the convention here, as a reminder, is that 50 delta call is equal to a -50 delta put option, right? And so, as a reminder, the 25 delta put and 25 delta call are roughly equidistant away from the at the money option, or equidistance and out of the moneyness. Now, there are two standard skew summaries that traders use. And the first is the 25 delta risk reversal, which I've already mentioned, which is the distance between the 25 delta put and call. So that measures how asymmetric the smile is, right? Specifically, I'll just draw it again. Here we're going to have K relative to the futures price, right? Sigma implied, right? So is it really steep and flattens out here such that, here's my 50 delta, which is at the money. And then here's a 25 delta put, right? And then this is visually about the same, 25 delta call. While they're both equidistant from the 50 delta at the money option, you can see that the put one is steeper relative to the distance between, the at the money and uh, uh, at the money option and the call option. Obviously, not quite drawn to scale here, but you kind of get the point. That measures the asymmetry of the distribution. And then there's also the 25 delta butterfly. We talked about the butterfly position before. Remember, it's got that sort of peak in the middle. It's got some wings. Um, and what this is actually used for is so you're taking basically uh, half of the distance between the two 25 delta implied vol options minus the distance, or I should say the implied volatility of the at the money option, which will measure the curvature of uh, the option. So specifically, in the implied volatility space, is it more convex like that, or is it straighter, right? So so far we've talked a bit about the smile at a fixed maturity, but implied volatility also varies with maturity itself. So hence we're going to talk about the term structure of volatility. Now, the 30-day at the money volatility and the 1 year at the money volatility on the same underlying asset are typically different. The shape of the implied volatility with respect to time is this volatility term structure. So we have two common regimes. The first is contango, which is upward sloping and is considered the normal state. Uh, Basically, what this means is the market expects volatility to revert towards the mean over a long run average. So longer dated options, way out, right, carry slightly higher volatility than near dated ones because they're more sensitive to oscillating around that average. Essentially, you have to pay more in terms of, volatility, as it were, for longer dated options. In terms of the other picture, backwardation, this is a downward sloping curve. And remember, this is in time space for a given level strike price on the same underlying. It usually signals some near-term risk, right? So it could be like an earnings call that is coming up for a company. It could be, the Federal Reserve Operating Committee meetings, right, where there might be an interest rate decision. Could be an election, geopolitical headlines. Basically, the front of the curve, meaning near dated options, get bid up because the market needs to price in some imminent event, right? Something very near term. And then once the event passes, then the term structure will revert back to, contango. So the VIX term structure is, watched closely as a regime indicator, actually. The implied volatility of the VIX on the S&P 500. So again, it's a very forward-looking instrument that traders, not only option traders, but equity traders, bond traders, macro event traders tend to look at is the VIX. Now, this is our big picture concept here. Our volatility smile combined with a term structure of implied volatilities gives us something called the implied or the volatility surface. That is our sigma here, volatility or standard deviation, is a function of the strike price relative to the futures price, right? And time, right? So when we combine these, we end up with a two-dimensional surface, or technically, when we plot it into a three-dimensional surface. Um, so, um, how do we do that? Well, for each maturity, we'll vary the strike price and create a smile, which is just one slice, a cross section, if you will, of the time periods. And then we can also fix the strike price, essentially at the money, for an example, and then vary it across time, and we'll see a slope from or a slice from the different direction, right, across time periods. And so the market output is essentially this whole surface across the entire market here. Um, Now, practitioners typically fit a parametric, just meaning, it comes from all the parameters of the inputs to the price of the option, right? They fit a parametric surface to the observed market prices each day, and then interpolate, right, the price to price these potentially illiquid strikes, meaning sometimes options don't trade for the longer dated stuff. So they have to kind of bootstrap or interpolate, right, across different maturities. And then, they're constantly recalibrating this thing. And the surface is what the firm's pricing system actually carries, right? Essentially everything we've talked about today, the smile shape, the skew, and now the term structure of the regimes, essentially just a description of one slice or one feature of the surface. So here's some empirical data, and we'll graph one for you. Here's a real surface one, or as close to approximation as we can get it. So on the top part of the chart here, we have the ratio of the strike price to this underlying share price. So this 1.00, that's at the money, right? Then to the left and then to the right, right? So means basically the share price is going up to the right and the share price is going down to the left. Now we see a couple things. Let's read across any one of the rows and we can see that the smile at that given level of maturity. So if you look at the 1 month, right? So for the lower share prices, it's 14, and then it goes down to 12 at the money, and then back up to 14, equidistant from the at the money option. So they look about the same. So that's sort of your U shape. And, we're looking at this is a foreign exchange smile here. So that makes sense. Okay. And then when we read down any one of these columns, we'll see the term structure. And we'll see here, if we're just looking at the at the money option, it's, implied volatility of 12 when it's at the money, which is on the lower end, and then it increases largely monotonically out until you get to year 5 up to 14.4, right? This is representing contango, right? Because it's downward sloping towards towards maturity. Okay. Now let's look at how the smile tends to flatten and steepen with maturity. So the short dated smiles are a bit sharper, if you will, meaning it's more of a U shape because the range is 2.5 between the 0.9 and the 1.1. That range is I'm sorry, between the highest end of the range 14.5 and the at the money option. That's kind of the slope, if you will, going down in the valley of the U of 2.5. And as the maturity increases, you'll notice that the range is more narrow, right? So between 15 and 14.4 or 0.6 in this case. And this is, a structural feature. At short maturities, the implied distribution is far from log normal. So the smile is a bit more pronounced. And at the longer maturities, the law of large numbers kind of smooths things out. So the distribution will approach log normal distribution, and the smile will flatten out. So this is one of the more constant empirical features of volatility surfaces. Um, Now here's a picture of if we draw this in three-dimensional view. So here's our original x-axis, if you will. The strike price relative to the share price. This would be sort of our y-axis here, which is the time to maturity. So we're adding that third dimension, and then our y-axis here is the implied volatility. So same data, but now we're putting it on a graph. It's the same data from the prior slide, so it's just rendered as a surface. And you can see here as maturities increase, there's higher implied volatilities, so the data points are up higher. For near dated options, the skew becomes more steep. You can see here, like in the valley, it's a bit steeper than these longer dated options out here. And of course, it's downward sloping. And I actually have have an interactive on this slide, so maybe I can. It's harder for me to pull it off. But when you open the slides, you should be able to get a sense for, you can spin the object around, and it's basically, you can kind of see it, it's going downhill. This is at the money, and it kind of peters out here at the bottom. So it's less steep in the valley, higher up the ridge, if you will. But as we get further into the valley, these are the more near dated options. It tends to be more costly when they're out of the money at these points relative to at the money. All right. In this final section, we'll talk about when the smile frowns. This essentially happens when they believe a binary event is coming and the outcome is going to push the price either way up or way down. So it's, the smile flips upside down. Okay. So this is what the picture would look like in a binary outcome expectation. We talked a little bit about this picture earlier, but this is an event where the expected, uh, um, an example of this would be, where we have an event that will move the underlying by some known size in one direction or another. Typically, you'll see this like in a takeover announcement for, mergers and acquisition. Could be like the results of a drug trial for a small biotech. It could be the result of a court verdict on maybe a major lawsuit against a firm, or even a major earnings report for the firm. In this case, the expected post-event price is not going to be normally distributed around today's price, at least. It's essentially bimodal. It's concentrated around two outcomes. And so when you back out the implied volatilities of that distribution, you get this inverted U shape. Basically, at the money options are really expensive because everyone's buying the at the money option, right? In either direction. And it says that the underlying asset price is unlikely to land near the current strike price, while essentially out of the money and in the money options at the two expected outcomes are relatively cheap. The underlying is likely to be near those different strike prices. So we call this the frown. Okay, so what does this imply about the distribution? Okay, let me show you an example. Let's say the stock price is currently $50, but in 1 month we know it's going to be either 42 or 58. Okay. An example of this would be like a takeover announcement, right? There's a takeover announcement, and the offer is that it's for $58 a share, and it has to go to the board for acceptance or rejection. And now, if they reject it, maybe the company was suffering, so the stock will fall down to $42 if they reject it. So let's assume that the market thinks these two outcomes are equally likely. Well, the implied risk neutral distribution 1 month from now is not a bell curve, like centered around the stock price. It's a mixture of two very narrow, peaked log normal distribution, one centered at $42 and one centered at $58. And basically, there's no distribution around the current share price itself. Now, think about the implied volatility of an option that's struck at $50. That option pays off whichever way the event resolves. $50 strike call is worth $8 if it goes to 58, or right, $42 strike put is worth $8 if it goes to 42. Either way, the option has a guaranteed $8 of value, right? So to get a Black-Scholes-Merton model with the implied volatility that reproduces this $8 value, we need a very, very large sigma, right? Implied sigma, which is going to be much higher than the actual underlying volatility. And that's why the at-the-money implied volatility is so high in this example. Okay. So in summary here, key takeaways from today's lecture. The option markets are always pricing a surface of volatility and not a single measure of volatility. That's our first important takeaway here. Excuse me. Now, the market knows that, and of course, prices around it. So what comes out is a smile and a term structure, and ultimately this surface. So the shape of that surface tells you what the risk-neutral distribution that the market is pricing, which itself, of course, is a forecast about future tail events and asymmetries. For example, the equity skew is basically about crash protection after 1987. The foreign exchange smile, right, is talking about jumps and these, the volatility of volatility on both sides. A frown is an expected binary event. Each pattern has some economic content. And the trading desk job is to read those different surfaces and try to hedge what those surfaces imply. And ideally to identify a few situations where the market surface is mispriced relative to, the trader's view of the true distribution. Okay. And that's where we'll leave it today. Again, not a single sigma. The Black-Scholes model is the model we use to back out the different applied volatilities, assuming, of course, that current prices are a reflection of everyone's expectations of volatility. When we convene again next time, we're going to talk about the structured finance market, going back to, I think this is chapter 8 now. We're going to discuss securitization, the process, and talk about securitized products, and most famously discuss the mortgage-backed security markets that led to, or at least helped precipitate, the global financial crisis almost now 20 years ago, but does have some relevance today because there are plenty of over-the-counter options, or over-the-counter structured products these days, which will lead us into our final discussion about derivatives mishaps. We'll see you on that one. Take care.